Right, here we are. Welcome back to school. It's been a whole 3 weeks since the spring ended. Is everyone here? I think this might be everybody, but we might have somebody new here as well. So, all right. Well, I'll assume that we all got our invitations. And so, first of all, let's take a look at this syllabus. And wait, everything. Let's see. I had Blackboard open here a few minutes ago. Here it is. If you go to Blackboard for this class, you'll see that the syllabus is in the separate category, syllabus, and then everything else is under what we'll call course readings. Okay, chapter 1, chapter 2. Now, when we are done with each class, I'm recording this right now as we speak. So in the past, I was able to successfully store the videos right here on Blackboard because it apparently is well set up for doing something like that. But if we run out of space, what I've also done in the past is I've put the recordings in my own YouTube account. Okay, so I'll let you know how that's going. I know that supposedly Blackboard has enough room that I can store the videos. They are very space intensive, apparently, especially because this is a fairly long class. So if I am able to keep them on Blackboard, I will. Otherwise, I'll let you know where to find them in YouTube. And the good thing about the recordings is that, of course, if you can't be here, you can certainly watch the recordings. Or if there's something you want to go over again, you can watch the recordings. And so it's good to know that they're there. All right, so why don't we open up the syllabus real fast? Now, as you know, this is an entirely online class, which normally, in a normal year, we'd be in class right now. And we'd be in, on the campus and all. But that's not the way it is this year. So you should be able to read this on Blackboard. So just a few details that we want to remind ourselves about. First of all, the class will meet every Tuesday at 7 o'clock. The official ending time is about 9:45. We don't always need that much time, but we'll play that by ear a little bit. Since it's such a long class, we'll have a break in the middle somewhere, and we'll figure that out. We'll play that part by ear. But since you're home, you have plenty of time to make up some coffee or something stimulating halfway in between, which you'll probably want to do because, again, this is a very long class, although very interesting. And so there's a book, and it's actually a very good book. It contains a lot of good material. It covers a lot of very important topics. Now, I luckily have the ability to get my own online version of it. You can get one too, but you have to pay for it, of course. Let's see if I have it here. Let me at least show you what it looks like. There we go. So this book, let me show you the cover. Financial Markets and Institutions, 13th edition. I guess, wow, I wonder where that is. Yeah, it's been a while since I was able to go down there, but yep, there's the big city. And this is Jeff Madura. And I find it to be a very well-written book. It's very clear, it's very well organized, and I've used other books by him as well. So that's why I try to stick with him whenever possible. So anyway, that's all the details are right here. And then let's skip ahead a little bit, and you can read all this discussion later on, but there will be periodically some assignments based on the chapters that we've covered, and a midterm and a final. And that's all we need to do. We don't have that much time. We only will be meeting until, I think, the first week in August, or possibly the last week in July. So we're going to be, the semester won't be quite as long as what we're used to. So we don't have time to do anything more than this. There's certainly no time for paper, for example. I'm sure nobody is disappointed to hear that. I mean, really. Is anyone here upset to hear that? Good. That's good, because there's not going to be a paper. There just isn't time for it. Okay. That's just the way it is. But instead, there'll be some assignments. And like I said, in the midterm and the final. And before we have any exams, we'll review everything. And I'll give you practice problem sets to work on. And let's see, what else do you need to know? Well, they have all the language that is required for every Manhattanville syllabus is here. Everything is in here somewhere. It's basically a short novel. So yeah, but I mean, down here you can see what topics we're going to be covering, more or less. Now, since this is the first time I'm using this book, I can't perfectly 100% predict what we'll cover every single week, but this is a pretty good, roughly a rough approximation. The idea is to typically cover 1 or 2 chapters each week. And this way you'll know what to expect. All slides, which I for these the book, I know every textbook has its own slides. I don't like to use them because I find it to be very restrictive. All these slides here, I wrote them myself. It's a lot of work, but I find that it's easier to teach out of it if I've done it myself. So we'll be going over these tonight. Let me just download them right now. Number 1, chapter 1 is the role of financial markets and institutions in the economy. And number 2 is a look at how interest rates are determined in the marketplace. This is known as the loanable funds theory, actually. So these are a good starting point for everything that will follow. Now, I want to show you where we're going with this course. We've got, let's see. So first we start with the, like I said, we've got just an overview of financial markets. We have our discussion about the loanable funds model. And then down here, we'll take a more close look at interest rates and bonds. And we also will be looking at the Federal Reserve System. And of course, you probably already know the Federal Reserve System is the central bank of the United States, and they're the ones who ultimately determine the level of interest rates in the economy. So it's very important to understand how the Fed works, what they're trying to accomplish, and what tools they have available to carry out their different tasks, including monetary policy. And while we're there, that'll give us also an excuse to go over money itself. We'll be maybe taking a brief detour into the history of U.S. money, which I think you'll find extremely interesting. And of course, because the Federal Reserve controls the money supply, we have to understand what money actually is and the different ways it can be measured. We think we know what money is. Isn't it those green pieces of paper in our pockets or wallets? Well, yes, those are an example of money, but money is a much broader concept than just green pieces of paper. So we're going to see some interesting cases of different alternative versions of money that have been used throughout history. So then we'll move on to, let's see, what are we talking about? Oh, more detailed discussion about monetary policy. Let's see, then we're going to move to, short-term securities, the so-called money market. And then we'll be looking at global bonds and how to measure the risk of holding bonds in your portfolio. And then we'll move ahead and look at equity markets. Of course, that means stocks. Oh, what else? Oh, and then different models for pricing stocks and also trying to determine the risk of stocks. Man, what else can we do in this class? Oh, and we'll start looking at derivative securities, which are very exciting. They're mainly designed to help us hedge risk, but they can be used for speculation as well. And let's see, we also want to look at, actually, we're going to finish up with 3 different types of derivative securities and try to understand how they're priced in the market and what kind of hedging strategies we can use with them. So by the time we're done, we will have covered a very broad array of financial securities. We'll understand their properties, we'll understand what they're used for, and we'll understand how they're priced and how they can be used to hedge risk in the case of derivatives. So by the time we're done here, you'll be able to make heads or tails out of any journal article you might find, any Wall Street Journal article. Anytime you hear something in the news about finance, this will give you a much better background to help you understand what they're talking about. Okay, because you know that much of the news is dedicated to finance and economics. Okay, a day does not go by without exciting news about the markets. In fact, here's a good source if you really want to keep up with the markets without, obviously spending too much time. There's a nice website here called cnbc.com where they give you a lot of useful information in a hurry. Looks like the markets aren't doing so well today. The red usually means something negative is happening, but you can see the different indexes are listed here. And there's stories across here about all these different markets. We have Asia, Europe, the United States, bonds, oil, gold, foreign exchange, crypto. Man, Bitcoin. Woo. 2 weeks ago, wasn't it? It was worth about $50,000. Yes, it was. And look at it now. Well, you know what? You kind of expect that when you're buying or selling an asset that doesn't actually exist. If you ask the average person what Bitcoin is, I don't think anyone, including myself, could actually explain what it really is. So that means it's kind of tricky to figure out what it's worth. And if anybody gets nervous about Bitcoins, then the price can fall very, very quickly. But we also have articles up here about, all the different aspects of business, investing, technology, you name it, it's here somewhere. So, maybe each day you can find a few minutes to take a look at what's going on in the markets and take it from there. And then the more you learn, the more you'll understand what's going on. And so this is the best way to become comfortable with financial news and financial markets. All right, anyway, so now we're going to start today with chapter 1 and 2. And chapter 1 is a look at, like I said, it's an overview, a fairly quick overview of different types of securities that trade in the marketplace. Now, there's quite a few. Now, we obviously don't have all night. We can only touch on these topics right now, but we will come back and revisit all of these as we go along. So right now, we're just taking a broad overview of these different securities, but we'll definitely come back and revisit most of them and look at them in more detail later on. So what kinds of securities trade in the marketplace? Well, as you know, there's quite a few, but these are the ones we want to focus on right now. We have what are called money market securities, bonds and stocks, which you may already own, in fact, for your 401k plans, mutual funds, which are basically collections of stocks. They're designed to be very, minimize your risk. Of course, real estate, everybody knows what that is. And then finally, we have derivative securities, which, as I mentioned earlier, are designed to help reduce risk. Okay, they were created to make it possible or easier to hedge risk, but they can also be used for speculation. And there have been several cases throughout recent history of spectacular losses that took place at companies that used derivatives very badly without really understanding what they were worth. About 30 years ago, for example, the treasurer of Orange County, California, lost something like 3/4 of the county's money by playing around with derivatives that he did not obviously understand how they worked. It happens. You get, there's a school in Texas somewhere where they lost 3/4 of their endowment because of derivative securities. The brokerage firms, Lehman Brothers and Bear Stearns, went out of business in the 2000s, early 2000s, because they were fooling around with credit derivatives that they obviously didn't understand. So anyway, why don't we start with the basic ones, money market, for example. So the money market obviously doesn't mean money itself. What we're looking at is what are called very liquid, short-term securities. Now, let me just take a little detour here and discuss a little further what we mean by this word liquid. Okay, a security is liquid A financial asset is said to be liquid if it can easily be converted into cash. Okay, so for example, cash itself is the most liquid asset, followed closely by checking deposits and savings deposits. So if you have money in your checking account, it's easy to convert it into assets. I can easily take a check in most cases, maybe not every single case, and use it to buy something. So of course, I have to go through the formality of writing the check, and not everybody accepts checks, but they're very close. They're very almost as liquid as savings account. I'm sorry, cash. But savings accounts are not quite as liquid, because with a savings account, you can't take your passbook into a store and buy things with it. You have to go through the formality of going to the bank and getting your cash. Although in this day and age, you might be able to get on your phone and switch funds out of your savings account into your checking account, which could be tied to your debit card, and then you can spend it directly. So the technology is making it easier to access your savings account, whereas in the past, you would have had to go to the bank and get your cash to spend that money. Stocks and bonds are less liquid than cash, checking, and savings accounts, or I should say cash, checking deposits, and savings deposits. Why do you suppose that is? Why would they be less liquid? Yes, go ahead.
You have to go through the formality of actually selling your stocks in order to convert it to cash.
Exactly. That's right. And that can take up time and money. Stocks and bonds have to be sold before the proceeds can be spent. And this will require at least some time and expense, which reduces the liquidity of stocks and bonds compared with cash, checking deposits, and savings deposits. Now, they're not extremely illiquid, but let's just say that your mortgage is due tomorrow and you have a stock in your hands, which is enough to pay for the mortgage. Do you think that you'll be able to get the money ready in time? It's possible, but possibly not. So in that case, you probably would have been better off keeping some of your wealth in the form of checking deposits and maybe not hold quite so many stocks. Now, of course, some financial assets are highly illiquid, such as real estate, art, precious stones. Because in those cases, of course, how long might it take for you to sell a piece of real estate if you really need the money? It could take a good long time. And even then, you might not get the full value because it's a very slow market. In other words, you might get lucky, but you might not. So that actually raises an interesting question. Why do people hold illiquid assets?
Because they increase in value?
Yes, that's right. Because they may provide investors with capital gains, and in general, their rates of return are greater than for more liquid assets. For example, what's the rate of return from holding cash? It's zero. Nobody's going to pay you interest. But how about even a checking account? What kind of interest are you getting paid on that? It's not. It's like a rounding error. That's how low it is. You probably have to keep $1 million in your checking account to earn $1 worth of interest. Let's say it's pitiful. So what people tend to do quite wisely is they try to find the right balance between liquid assets, which you must have because you'll have, bills to pay and you may have unexpected expenses. You never know when that tree is going to land on your roof, or, things can go wrong and you have to have money to fix those problems. But if you keep all of your money in the form of cash, you're never going to retire because you're not going to ever earn enough money. So you want to have a good combination of stocks, let's say, and cash or checking deposits, which meet your needs for liquidity, but also provide you the highest possible rate of return. So there's a need for all these different financial assets in the economy. There's people will buy and hold a combination of all of them. So the money markets that we're looking at right now consist of only liquid assets. Okay, in other words, there'll be many different kinds of securities you could buy and still be considered to be money market securities. Stocks and bonds, though, do not belong to this category. It's only the very highly liquid securities that do tend to offer relatively low rates of return. So what could possibly belong in this category? Here's a few very popular money market securities. We have what are called certificates of deposit, which you may have encountered already, commercial paper, which is normally only sold by businesses, and treasury bills, which you may already have some experience with. It's not impossible. So let me see, where was I? Oh, yes, here we go. A CD, certificate of deposit, is a special type of bank account in which the investor must leave funds on deposit for a specific length of time, usually somewhere between 1 and 10 years. But the good thing is that you get more interest than you would from a traditional savings account. Now, it turns out that the larger CDs can actually be traded between the banks. If they need to raise money in a hurry, they can actually sell your CD to another bank and cash it in, basically, and use that to invest in something different. And then hopefully more deposits will come in so that when the person who owns the CD wants their money back, you'll have it ready for them. So certificates of deposit are considered to be money market securities. What is commercial paper? This is a short-term debt instrument issued by corporations to raise cash for very short periods of time, typically 270 days or less. It seems like a peculiar amount, but that's based on legal restrictions. So it's a way that they can borrow money from investors rather than going to a bank. And the advantage of a commercial paper is that even though it's technically a loan to a corporation, if you own a commercial paper, you can sell it to somebody else if you need the money in a hurry, which isn't normally possible with a loan. Okay, so commercial paper is an example of a money market security. And we also have, of course, treasury bills. We know who issues those, the U.S. Treasury Department. Now, the U.S. government issues these to raise money because, of course, they constantly have deficits. If taxes were high enough to pay for all their spending, there wouldn't be no need for treasury securities. The existence of treasury securities represents debts issued or run up by the federal government. Now, these are very short-term securities. They last 1 year, I think it's anywhere from 1 month to 1 year. And they're very liquid. You can sell these at a moment's notice, but the interest rates they pay are pretty low. Now, part of the reason for that is because they're so safe. These are guaranteed by the US government, and the government, unlike a commercial bank or a corporation, has the ability to raise taxes. So if they're running out of money and they can't afford to pay for the treasury bills that they've issued, they can raise taxes and then pay for them anyway. So in other words, that's one of the reasons why they're so safe, because the government can always raise the money they need to cover their debts. Now, just out of curiosity, I mentioned that these have such low rates of interest, why don't we find out what they are today at this website called Daily Treasury Yield Curve Rates. And what they do, it's just a list of all the different treasuries that are trading today, organized by their maturities. And each one will tell us what kind of interest they're paying. And don't laugh too hard when you see these. Right now, 1 month treasury bill is paying 0.01%, 1/100th of 1%. But if you go up to 1 year, that goes all the way up to 0.04%. Wow. Now, if you look further along here, these are, when you get past 1 year, these are referred to as treasury notes, the ones that last for 2 to 10 years. And these last two, 20 and 30 years, are known as treasury bonds. Now, when you get into this neighborhood, you can start to earn some interest. I mean, less trivial rates of interest. In other words, you can actually go as high as 2.30% if you're willing to hold a 30-year bond. A lot better than 0.01%, that's for sure. So these are referred to as treasury bills, and they have the unique feature that they're sold at a discount from the face value. In other words, let's say that the treasury bill is sold with what we call a face value of $1,000. That's what it will be worth on the maturity date. But we pay $980 for it. So we pay $980. In a year, when the treasury bill matures, we'll receive $1,000. And so that means we'll make a capital gain of $20 instead of them sending us interest payments. Why do they do this? Well, because it has such a short maturity. Treasury bonds and notes do pay interest directly, but they only pay every 6 months. So it makes sense for them. But here, with such a short maturity, the thinking is that why should we have interest payments when the bill will mature very soon anyway? So for these, what you do is you pay for it with a discounted price, and then you get the full face value on the maturity date. And so that gain, that your profit there, is referred to as a capital gain. Okay, now, by the way, you may have heard of money market mutual funds or money market deposit accounts. These are available at banks, and what they basically do is, instead of putting all your money in a regular checking account, you put your money in a money market deposit account, and you are going to be buying into a pool of money market securities, which provides you with a higher return than a traditional checking account, and you have limited check writing privileges. Now, the only drawback is there's probably a fairly high minimum investment requirement. But if you have the money, it's probably easier than leaving all your money in your checking account. Because, in this day and age, how many checks do we really write anyway? That used to be more of a problem when people would typically write 20, 30, 40 checks every month. Now, who uses checks anyway? So you might want to look into getting a money market deposit account instead of a traditional checking account, or in addition to it. So you can earn a little extra interest and still have check writing privileges. All right. In fact, what we could do? We could look on the internet and see what kind of rates they're paying. Okay, Ponce Bank is paying 0.51% on its high yield market deposit account. All right, that's one example, but you can see it's a little higher than what you would get in a savings or checking account. And you can do some some research and ooh, man, there's some nice options on here. Maybe we should think about this. Okay, anyway, that's what that's all about. So money market securities. Now we're going to switch to bonds. Now, bonds are very long-term securities. You may actually have bonds if you have a 401k plan, for example. When you choose what funds to invest in, it's possible that some of the funds you chose have some bonds in there and not just stocks. It depends. Every fund is different. But bonds are a very long-term type of debt security. And what happened here? Looks like they're slightly out of order. All right, let's do bonds next. A bond is a debt instrument that is issued by a corporation or a government to raise long-term funds. And when I say long-term, I mean up to 30 years. So this is the opposite of the money market securities, which were very short-term securities. Short-term meaning less than a year or a year or less. Here, these can go all the way up to 30 years in the United States. Now, it can go beyond that. It's not common. But about 30 some odd years ago, the Walt Disney Company actually issued 100-year bonds. And they had a special name. I can't remember what they were called now. Let's just double check that. Oh, I thought they had some kind of unique nickname. No, maybe not. But anyway, so yes, it does happen very occasionally. So you have, but normally bonds, government bonds, corporate bonds, you name it, almost without fail, the maturity is not going to go beyond 30 years. Okay. Now, who issues these bonds? Well, corporations, certainly the federal government, state and local governments, and then finally foreign corporations and governments may also borrow in the United States. So as an example, what if we buy a 30-year treasury bond? Now, looking at this chart here, the treasury bond, 30-year treasury bond currently pays 2.3%, which is not great, but it's not terrible compared to these other ones. So what that means, typically a bond like that would have $1,000 face value. That's how much it's worth when it's first issued and how much it'll be redeemed when it matures. So basically, when you buy one of these, you're lending the US government $1,000 for 30 years, over which time they will have to pay you interest. In this case, 2.3%. Now, suppose that the bond has what we call a coupon rate of 5%. That means that every year they owe you $50 worth of interest, because that 5% means 5% of the face value. So in other words, if you look at a quote in the New York Times or the Wall Street Journal, and it says that this certain bond has a 5% coupon rate, that's what they're talking about. It tells us how much interest we can earn from that bond every year. Now, if you want to see some actual quotes, let me just check this out real fast. There's an organization called FINRA. I don't remember what FINRA stands for. But they keep track of bond market data. And although I find that it's very clumsily organized. Let me try this. Aha, Market Data Center Bonds Guide. I want to look up and see what bonds have been issued, let's say by Apple. Okay, let's see. So I mean, it's a little bit clumsy, the way they've set it up. In fact, very clumsy. See, this shouldn't be necessary. Geez, I know, it's just unbelievable. So I'm going to tell it to search for Apple. I'll agree to the agreement. There we go. So what exactly is this telling us? Now, these are the bonds that Apple has issued. And let's just grab one at random. How about this one? Now, this bond will mature on May 3rd, 2023, which means it was probably issued a long time ago, let's say 25, 30 years ago. The coupon is 2.4%, which means out of $1,000 face value, that means it will earn $24 worth of interest every year. And over here, we have credit ratings. And you've probably heard of these companies, Standard & Poor's and Moody's, and they provide credit ratings for all bonds issued in the United States, more or less. And these letters tell me how safe this bond is. So for the Standard & Poor's scale, let me just show that to you quickly. The rankings for Standard & Poor's look like this, and you may have heard of these before. It starts at AAA, then it goes down to AA plus, AA, AA minus, A plus, A minus. Then it drops down to triple B plus, triple B minus. And now, by the way, this group of bonds, these are all collectively known as investment grade. It means they're relatively safe. But the lower the rating, the higher will be the coupon rate. So for example, if you look at Apple, AA plus is almost as high as it can get. So their coupon rate is quite low. If you were to pick up another bond or look at another bond from another company, let's say, what company should we look at to compare them with? Let's think of a company. Oh, crap. No, it just keeps faking me out here. All right, what company should we pick? How about a company that's in a bit of a spot of trouble these days? Who could that be? How about, I'll go, let's try General Motors. Not that they're in trouble, but they're probably not doing as well as Apple. Oh, this is the detail for a single bond. Let's see, where's that credit rating? Oh, it's not even listed. All right, let's try somebody else. How about Ford? There we go. Oh, look at that. They're rated. Some of these bonds are rated AAA. It depends on when they were issued. Like some of these other ones, look at how low they are, double B plus. So for example, look at this double B plus bond. The coupon rate is 9.95%. That's pretty high, especially in this day and age. And that's because when this bond was issued, the company was in a lot of trouble. Double B plus means they're not even investment grade. When you fall out of this top tier, double B plus, double B minus, B plus, B minus, etc. These are called speculative or junk bonds. How do you like that? So, but the bottom line is the coupon payment that you're being offered depends, among other things, on the credit rating of the bond, which totally makes sense. Nobody would buy a risky bond unless they were offered a very high coupon rate. And so here's all the different bonds that they've issued, and the prices are listed over here, the credit ratings, the maturity dates, the coupon. So pretty much every detail you could possibly want to know about one of these bonds. Let me just randomly grab this one. If you need more information, that's what this is supposed to be. So you've got the coupon, the maturity, the ticker symbol, QSIP, all these other useful pieces of information. The bond is initially, they offered $2.5 million worth of this bond. Yes, and the ratings, this is the history of the ratings. And so, okay.
Professor, so
Yeah.
basically, the coupon is the interest rate that's going to be paid out per year
Yes, that's correct.
for the life of the bond.
That's correct. Once it's determined, that it never changes. In fact, when you buy a bond, you're actually entering into a contract with the bond's issuer. And that contract has a special name. Let me throw it in here. The contract is called an indenture. And that indenture contains all the details that you need to know. The maturity date of the bond, the coupon payments, any special features, they're all in that contract. They do not change. Now, before we go any further though, you'll be wondering, why are interest payments called coupons? When you think of the word coupon, what do you think about? Well, in ancient times when we still had newspapers, if you might have a little coupon that said, if you cut this out and bring it to the store, we'll give you $1 off on paper towels, let's say. Now, bonds, of course, are traded in the market like all other securities. Everything's done through computers. If you buy a bond, it appears in your account. The interest is credited to your account when it's due. But what about 100 years ago? Did it work that way? No. In fact, watch this. Now, I'm sure it's going to be hard to see this. It says United States of America, 9% Treasury note. Now, this isn't that long ago. 1987, it looks like. It matures. It was sold. It looks like they issued this as a 10-year bond. Now, look at these little pieces of paper down here on the bottom. Oh, what is that? Let me see if I can make this bigger. All right, it's a little fuzzy there, but you notice how it says August 15th, 1988, $45. That means that the owner of this bond on August 15th, 1988, could take a pair of scissors and cut that little strip off and bring it to the bank and be paid $45. It's actually a coupon, a physical coupon that you use to collect your rent. And so you can see this is where the name is coming from, coupon. It was an actual coupon, and it wasn't really that long ago that they discontinued this. So, and the bond itself is a certificate. And you can see there's Mr. Lincoln right there. This is a U.S. Treasury note, 10-year Treasury note for $1,000 issued in the late 70s. And every year for 10 years, they received 9% interest, $90, which was split in half. You actually got $45 twice a year rather than $90 once a year. That's traditional for the U.S. Treasury Department. And so each coupon is worth $45. So the 9% is the coupon rate. The $90 is called a coupon. Okay. And since we have semi-annual coupon payments in the United States, by convention, that means each coupon payment is actually $45. And that's how it worked all throughout all those decades until recently. I don't know exactly when they stopped having coupon bonds, but it wasn't obviously, as you can see, all that long ago. But that's where the name comes from. How do you like that? So the next time you cut out a $1 coupon for paper towels, you'll think about Treasury bonds. Now, there used to be a museum in Manhattan called the Museum of American Finance, and they had a lot of very interesting historical stock and bond certificates. Unfortunately, the building was destroyed by flooding, and so they're still looking for a new home. But back in the day, you could go down there and see all these really interesting historical notes and stocks, but you also had a lot of notes and coins. In other words, historical US dollar bills and coins were down there. It's really sad that the place was ruined like that. They say that the collections weren't ruined, but the building was damaged and they just, had to move out. So maybe one day when they come back, you'll be able to go visit them. They actually have in their collection a bond that was signed by George Washington. So yes, they had some serious stuff there. All right, well, anyway, let's get back to this. All right, here we go. Now, in general, bonds are a safer investment than stocks. But in the long run, stocks will provide a higher rate of return than bonds. So financial planners usually recommend that people have some of each. They typically recommend that when you're young and just starting out, you have mostly stocks in your portfolio with some bonds for safety. And as you get older, reduce the quantity of stocks that you have and replace them with bonds. And so that by the time you're retired, you have mostly bonds in your portfolio. That way you'll have a lot of upside potential, but you'll also have a lot of safety as well. Okay, now let's go back to the list of securities that we were looking at tonight. And by the way, we'll get more deeply into all of these topics later on in the course. To think of tonight as sort of a smorgasbord of financial securities. We're just tasting each one, just a little taste. Okay, we'll have a full banquet about each one later on in the course. Okay, like a whole night of nothing about bonds and a whole night of nothing about stocks. So if we look at our list, what we can do now is look at stocks, which is everybody seems to find stocks the most exciting. Why not? The potential rate of return to stocks is quite high. And, they're just kind of fun. In fact, you may have seen some of these shows on TV where they talk about stocks nonstop, like Kramer, whose show is sponsored by CNBC. He's a lunatic, but, he brings up a lot of important points, and you never know what you might learn on a show like that. So what is a stock anyway? Who issues stocks? Well, stocks are securities that are sold by corporations only to raise funds, to carry out its daily operations, and to potentially make long-term investments. When you buy a share of stock, you are actually a partial owner of that corporation. Okay, so if I buy Apple stock, I own a tiny little piece of Apple, and I am entitled to share in their profits. Well, that's pretty nice because Apple tends to make a lot of money, but they can have bad years and good years, and so you have to be very careful with stocks. The one thing you don't want to do is put all of your money in a single stock. You want to diversify your risks by holding a variety of stocks that have different features. For example, you might buy stocks from different industries, like you might have oil stocks and retail stocks, and not just all oil stocks or all retail stocks. You may also have a mixture of very large and small corporations. You may have stocks from different countries as well. It didn't used to be easy for us to buy foreign stocks. Now it's a piece of cake. Okay, you can pretty much have whatever you want, depending on what bank you do your business with. So the share of stock provides the investor with partial ownership of the corporation. That means you get to share in the profits. And not only that, you get to vote at the meetings where they choose the next board of directors. So obviously, our primary purpose in buying stocks is for what we call capital gains. That happens when the stock price goes up higher than what we paid for it. If we're able to do this, we'll earn capital gains. Otherwise, we'll suffer capital losses. Also, though, we have potentially at least dividends, which are cash payments that corporations provide to their stockholders. And these are typically paid once every quarter. The board of directors gets together and they vote, should we have a dividend or not? Now, there's a lot of pros and cons to dividends. On the good side, these represent income to the stockholder. The problem with dividends, though, is that if the company is paying out dividends, that's money that they can't also spend on research and development or improving their production capabilities or investing in new equipment. So a lot of corporations don't pay dividends at all. And the ones who do typically pay fairly small dividends. They're not huge amounts of money. But that money does belong to the shareholders. And so this is a way that the corporation can split up their profits with the shareholders. Now, interestingly enough, while many corporations do not pay dividends, some of them are famous for paying very predictable dividends. For example, Coca-Cola has never missed a dividend payment. They were founded in 1892, and they've made a dividend payment every quarter since then. That's pretty impressive. And in fact, one time I stumbled onto an article on the internet, which you might find interesting, which is a list of companies that are in the same boat. Let's see if I can find it. Companies that have paid dividends for more than 100 years. Let's see who these guys are. Well, we have DuPont. Okay, there's no surprise there. They've paid dividends since 1904. General Mills, how do you like that? I think we all eat a lot of General Mills cereal, don't we? Yes, we do. Edison International is a utility company. I'm not that familiar with them. Johnson Control, Church and Dwight. Here we go. Stanley Black and Decker. Tools. That's all. Well, that's what I think of when I think of Black and Decker tools. Okay. Then we have, of course, our old friend ExxonMobil, which is itself a very interesting story, as you probably are aware, and we'll discuss this more later on in detail. In the turn of the 20th century, there was only one oil company in the United States. Does anyone know the name?
Standard Oil.
Standard Oil. And who was the owner of Standard Oil?
Rockefeller.
Rockefeller. Now, in the around 1912, I believe it was, the U.S. government decided to break up Standard Oil into smaller regional oil companies on the grounds that monopoly wasn't good for the economy. And so Exxon and Mobil were two different divisions. If I remember correctly, Mobil was Standard Oil of New York, and Exxon was Standard Oil of New Jersey, or maybe I have those two backwards. And eventually, of course, they remerged again and became Exxon Mobil. But if you include the years of Standard Oil, they've been around since the late 19th century, and they've never missed a dividend payment. Now, interestingly enough, the government, when they forced Rockefeller to sell off these divisions, that put a lot of money in his pockets because he owns these companies and he's selling them now to the public. And so by the time all of this settled down, his net worth in today's dollars was estimated to be about $600 billion, which means that Jeff Bezos is like an amateur compared to John D. Rockefeller. Okay, so anyway, then we have Eli Lilly, Con Ed, they're still around, of course. UGI, I don't know them, Procter & Gamble. You have a lot of Procter & Gamble products in your house, whether you know it or not. Okay, what do they make? They make like laundry detergent and toothpaste and things you use every day. And of course, our old friend Coca-Cola. And of course, we all know the origin of this name. It really and truly did have trace amounts of cocaine in it when they first started making it. And it was designed not to be a soft drink, but to be a medicinal product. You were supposed to drink it only if your stomach was upset. And eventually, when they were forced to take out the the cocaine, but they realized that it tasted pretty good. And so they started promoting it as a soft drink, and it really took off. It became one of the most famous corporations in history. And then we have, of course, Colgate-Palmolive. They make toothpaste and other things. And PPG, Pittsburgh Plate Glass, Chubb. Anyway, so those are the big survivors. They've been paying dividends for over 100 years, but you can see they're very much in the minority. In fact, you know what I'm going to do? In case you're interested in this, I'm going to put this link in the chat room, chat box, whatever you call it. And that way, it should be coming up in your chat box. And you can download this link and save it if you feel so inclined. If you find that financial history is exciting, well, there you go. And you can impress your friends at work by saying, you know, there's 15 corporations that have paid dividends for at least 100 years. How many do you know? And they won't know any of them. And they'll be very impressed with your knowledge of financial history. Isn't that one of the purposes of this course? To give you information to show off at work? Well, it helps. All right. So that's so much for stocks. Now, you may be aware that there's actually different kinds of stocks. In particular, we have the stock that when you normally hear the word stock, you're thinking of common stock. But they also have preferred stock, although many corporations no longer issue it. The two of them are designed for different reasons. Common stock is the one that enables you to share in the profits of the corporation and lets you vote. The preferred stock is really more a way of obtaining dividends. The price doesn't fluctuate very much, even if the company is doing well. But if there's going to be any dividends, they'll go to the preferred shareholders first. They have to be paid their dividends first. Then if there's any money left, it can go to the common stockholders. So the common stockholders are primarily interested in capital gains. The preferred shareholders are the ones who really are interested in the dividends. And you never know. I mean, like if let's say you're retired and you're living on a fixed income, the dividends from these preferred shares could be a very important part of your income. So it can be important for some investors, but most investors are more interested in earning capital gains from their common stocks. All right, so common stocks enable you to vote, which means you are voting for the next board of directors. The board of directors actually runs the company in the sense that they choose the management, and they also set the tone for the corporation. They set long-term goals and things like that, but they in turn answer to the stockholders. I mean, theoretically, everybody's watching everybody else to make sure that the corporation is being run as efficiently as possible. The board of directors oversees the running. They choose the CEO, of course, and they also make decisions about other areas like budgets, setting salaries for the management, specifying long-range goals, and of course, they are the ones who would maybe hire or fire the CEO if they don't like what he's doing. Yes, and so the common stock also provides you with the option to earn the opportunity to earn dividends, but again, the preferred shareholders come first. All right, so now we also want to note here that in the financial markets, stocks in particular can trade in two types of markets. We have the primary markets and the secondary markets. Now, when a corporation issues stocks, they don't normally do it themselves. Okay, here it is. When a corporation issues new stocks, they hire an investment bank to act as what's called an underwriter. The underwriter is the one that actually sells the shares to the public. So let's say you're Apple and you need to issue more stocks. You could approach Goldman Sachs and say, all right, listen, we want to issue more stocks. So Goldman Sachs would probably buy the stocks from Apple themselves and then turn around and try to sell them to the public at a profit. And this way, they could make money from the shares, but they also will almost certainly get paid a fee by Apple. And this is how they make their money, or among one of the many ways they make their money. This is the primary market. This is where Apple actually receives the money from the shares. Once Goldman Sachs starts selling those shares in the market, that becomes the secondary market. And like when you and I buy shares of stock, we're buying them from somebody else who already owns them. We're not buying them directly from Apple. So what that means is that when we buy the stocks, that does not provide any extra revenues to Apple. Okay, it's all coming from that initial sale in the primary market. Now, here's something you may have heard of, an IPO. What is that all about? Well, the first time a corporation issues stock, it's called an IPO. And sooner or later in the life of any corporation that is successful, they're going to need a lot of money to keep expanding. It's not going to be able to come from bank loans or even private equity. So instead, they decide it's time to go public and issue shares of stock for the first time. And this is a lot of excitement on Wall Street when this happens, because you never know what the public might decide the stocks are really worth. So investors in these IPOs can do very well, but they can also get clobbered. And if you've ever been in that neighborhood of the New York Stock Exchange, when an IPO is going on, it's almost like a big block party. It's really very exciting down there. They want everyone to know, yeah, we're going public today, baby. So you might recall when Facebook went public, it was a very disappointing outcome. They didn't raise the kind of money they were expecting. And you never know why. I mean, maybe they were being too optimistic, but at the time, at least, maybe people weren't quite so convinced that it could make money. All right. Now, who invests in stocks? Well, there's a lot of different categories. We have the institutional investors. We have the individual investors, that's you and me. And then we have the so-called day traders, which still might be you. It's not me. And of course, in this day and age, there's so many electronic platforms. Anybody can set up an account and start trading. It's not that hard. But most stocks are bought by the so-called institutional investors. That would be, for example, pension funds, insurance companies, that type of thing. Massive organizations that are buying stocks for their clients in order to make sure, for example, that the money that retirees are expecting is there when they get there. Or for the insurance companies, they have to make sure they have enough money to cover all the claims. So they may buy stocks to increase their rate of return so that they'll have money that they need when the time comes to pay out their claims. And then we could, and also commercial and investment banks would be included here. And they may buy and sell large quantities of stocks for themselves or for their clients. So these are referred to as institutional investors. Then we have, of course, individuals, where we buy stocks for our own account. And this is meant for our own individual long-range planning, in particular for retirement. Okay, everybody wants to retire as young as they can. That's everybody's dream. I want to be retired when I'm 43 so I can spend 50 years laying on the beach in the Bahamas. Does it ever happen? Sometimes. Most people end up working a long time. Some people actually continue working even when it's not really necessary. And some people just drop it all the minute it's possible. And then we have everything else in between. And then day traders. Now these previous two, for the most part, people who are institutional investors or individuals are buying stocks for the long run. Okay, this is part of their long range planning. Day traders are just the opposite. They're trying to identify stocks whose prices have gone up just enough that they can make a profit by selling them immediately. So in other words, they're trying to pick stocks before they go up and then sell them as soon as they do go up. This is why they're called day traders, because their investment horizon is very, very short. Now, if they can make all these good decisions, that might work. But the problem is that in many cases, their profits are likely to be overwhelmed by the cost of trading, because every trade requires a commission. Okay, so if you're going to be making small profits on every trade, the cost of the trading could actually wipe out all of your profits very quickly and easily. There used to be, you might remember, a lot of ads on TV trying to convince you to do day trading. Like they all had their own platform and like, oh, come on with us, we'll make so much money for you and blah, blah, blah. You don't see them on TV very often anymore, do you? Geez, I wonder why. I guess it wasn't as easy as they made it look. All right, so what was next? Let's go back to my list. I think mutual funds are next. Yes. Now, mutual fund is a collection of stocks or portfolio that is sold to investors in the form of shares. Every share you buy means you own a piece of that portfolio. So the funds have the advantage that investors can diversify their risks very easily without having to buy a large quantity of stocks in their own, which could get very, very expensive. Okay. Now, recently, this new innovation came along called exchange traded funds, which has a lot in common with mutual funds. But the differences are, number one, well, ETFs are traded in the market in the same way as stocks, where during the day you can buy or sell them, whereas mutual funds, you have to wait to the end of the day. Exchange traded funds are passively managed, whereas mutual funds are actively managed. So in other words, exchange traded funds are actually set up to replicate some kind of an index, like the Standard & Poor's 500. Once they've achieved that, there's no point in constantly trading stocks. They just do what they're looking for, and then they just keep that collection of assets together, and you will earn presumably as much as the Standard & Poor's 500. Whereas a mutual fund, they're constantly trying to look for bargain stocks. They're buying and selling and looking for the best deals. Those are called actively managed funds. And then, by the way, if you were to take a look at a list of what ETFs are available, I think you'd be surprised. Just about everything you could imagine. I would like to take a look at a list. No, I wanted to see if I could come up with a list. Maybe not. Well, anyway, you can buy ETF in just about any index out there, like the Standard & Poor's 500, but you can also buy ETFs that are based on the price of gold, for example, or the price of anything you can imagine. And so the whole point of it is that you're replicating the returns without having to actually buy those underlying assets. So like, what if I wanted to replicate the returns of the S&P 500? I don't want to go out and buy 500 stocks. This way I don't have to do that. I buy one ETF and then I've got hopefully the same rate of return as the S&P 500 for a much lower cost. Okay. And mutual funds tend to have higher fees than ETFs since they're actively managed. So this is a great way to diversify your risks without needing to buy a large collection of stocks. So the ETFs are very popular. So are mutual funds, but ETFs are relatively new. And so that gives us an opportunity to earn more diversification benefits without it costing so much. Now, the next category, we'll just briefly touch on real estate. Now, clearly, real estate can be very lucrative, but it can also be very risky. Now, they're not suggesting that you buy physical real estate. What you can do is invest indirectly in real estate through a security which is called a REIT, which stands for Real Estate Investment Trust. Now, a REIT is really essentially a mutual fund that consists of properties instead of stocks. That's really what it is. What's different, though, too, is that most of the income from REITs comes from collecting rents rather than capital gains, which is what you would get with mutual funds. All right. Now we're going to wrap up this chapter with a brief overview of derivative securities, although we will certainly look at this in much more detail at the end of the course. This is just meant to be an overview, but a derivative security is a special type of financial asset whose value is derived from an underlying security, such as a stock or a bond or any other type of security in the marketplace. In fact, that's why they're called derivative securities. The value is derived from other securities. And it's not just traded securities. The underlying asset could be the price of a commodity, like gold or oil. The underlying asset could be an interest rate or a stock index, like the S&P 500. And it's actually possible to buy a derivative security on completely non-financial variables like temperature and snowfall. Yes, for certain very specialized applications, you might want to hedge your risk. Let's say you own a ski resort. What's the biggest thing you worry about? Not enough snow in January. Well, guess what? You can buy a derivative that provides you with a payoff if that happens. So in other words, it provides you with protection from something going wrong. Now, some derivatives, now you know that stocks trade through organized exchanges. Derivatives sometimes do get traded through these exchanges, but sometimes they go through the so-called over-the-counter market, where, in other words, they're directly negotiated between the counterparties. In other words, the buyer and the seller get together and they agree on the terms, and then you have a trade. Now, not every exchange does deal with derivatives. The New York Stock Exchange certainly does not. But if you want to know where to find these things, the Chicago Mercantile Exchange is one of the biggest derivatives exchanges in the world. Now, if you go to their website, you'll see, if you look over here, these are the derivatives that they offer: agriculture, energy, equity index, foreign exchange, interest rates, metals, etc. If you look at those numbers on the right, those values represent the average trading volume in these different derivatives every day. So, for example, equity index derivatives, on average $644.1 billion worth, are traded every day. If you look at interest rates, $3.8 trillion worth every day. Now, what that means is that many financial institutions are hedging interest rate risk with these derivative securities. That's the point of this. They're hedging their risks. And we'll see this discussed in very great detail towards the end of the course. I don't know about you, but I see these as big numbers. And it shows you how massive this market really is, which is especially surprising because it really has only been around realistically. Most of these products have only existed since the late 20th century. They're invented at different points in time. So the agricultural derivatives have been around longer. It's the financial ones, like foreign exchange and equity index and interest rates, that have realistically only been around since the late 70s or later. The agricultural ones have been around longer because, of course, the US for many decades was an agricultural economy, and there was a need to hedge agricultural risk well before foreign exchange and interest rates. So many of these products were invented because there was a need for them. Okay, the exchanges created these products because suddenly became clear that we needed to do something about interest rate risk. And so the products proved to be very popular, as you can tell. Very popular. Okay. So where can we buy and sell these things? Now, by the way, you and I can buy derivatives. It's not out of our reach. It may not be a good idea, but we are able to do so. So we have here the Chicago Mercantile Exchange, which I just showed you, the New York Mercantile Exchange, which mostly deals with energy derivatives, the London International Financial Futures Exchange. Also, the Philadelphia Stock Exchange deals with currency options. So you never know where you're going to find these products. So there's four basic categories here: forward contracts, futures contracts, swaps, and options. all of which we'll study in great detail later in the course. But here we just want to have a brief introduction to them. But before we do that, since this is a very complex topic, why don't we find ourselves having our first break, well, our only break of the evening? I think we could all use a little refreshment and a little stimulation. So why don't we knock it off for a bit, like let's say 15 minutes or so, just enough time to get some stimulation going. And when we get back, we'll talk about these derivatives. All right? All right, I'll see you in a little while. All right. So let's just take a brief look at these four basic types. So we have forward, as you can see, forward contracts, futures contracts, swaps, and options. And again, we'll look at these in more detail later on in the course, but tonight we just want to get a main big picture overview. So now keep in mind, all these derivatives were designed for hedging purposes. So forward contract means you can lock in the price at which you can buy or sell an asset in the future where the price is settled today. Okay, so in other words, imagine yourself in a situation where you need to buy a foreign currency in the future. Let's say, for example, right now, the exchange rate between the dollar and the pound is $1.6980 per pound, which it isn't, by the way. It's a lot lower than that, but let's just say it is. And you also have a quote of a 6-month forward exchange rate, which means you can buy British pounds for delivery in 6 months at a price of 1.6715 per pound. Now, what that means then is that if I need pounds right away, this is how much I'll pay for them, $1.69.8. If I'm willing to take delivery in 6 months, then I can pay only $1.6715. Now, the purpose of doing this is that if I'm going to be buying pounds in 6 months, let's say I'm an importer and I do a lot of business in England, and I know that in 6 months I will be taking possession of some British goods for which I will pay pounds. I will have to buy pounds with my dollars. Now, I can do that now and eliminate any foreign exchange risk because then I know exactly how much I'm paying for the pounds. The problem with that is that it ties up my funds for 6 months. I could wait 6 months and buy the pounds at that time, but in the meantime, the price might have gone up. So what I can do as a compromise is I can lock in the price now at which I will pay for the pounds in 6 months. And so the good thing is that I'm not tying up my funds for 6 months. I'm getting rid of any risk that the price will go up. The only negative thing is that if the price goes down, I won't be able to save any money. So I'm basically saying, listen, I don't care. I just want to lock in a price and be done with it. I want to eliminate any potential foreign exchange risk. And so that's what this contract is letting me do. So these are very, very popular securities, especially in the foreign exchange markets, because so much trading takes place in the foreign exchange markets. In fact, at this point in time, something like $5 trillion worth of currencies are traded throughout the world every single day. So there's a lot of need for hedging securities like a forward contract. And so that's why they were invented in the first place, to make it possible for hedgers to eliminate the risk. Now, by the way, here's something you may have noticed this if you've ever traveled abroad and you had to buy a foreign currency. When you go to a dealer to buy a currency, you'll notice they always have two numbers. And those numbers are referred to as the bid price and the ask price. How does this work? Well, let's say you need pounds right now, not in the future, but right now. If I want to buy pounds, of course, I'll be expecting to pay the higher price, 142. If I'm selling pounds for dollars, I expect to receive the lower price, which is 132. This is how the dealer makes their money. Okay, the dealer who is willing to buy or sell foreign currencies with you, you'll have to pay a higher price to buy the currency, and you'll have to accept a lower price to sell it. So the smaller price is called the bid price, and the larger price is called the ask price. The difference between the two is sometimes called the bid-ask spread. And in this example, that is 10 cents per pound. And that represents the profit of the dealer. Now, you know from experience that when you travel, you get hit by this every time. Every direction, you're always going to end up paying the higher price and receiving the lower price. And usually the spread is much wider than this. Okay, you know from experience. In fact, a couple of summers ago, I was in France and I bought euros at, I think it was $1.27 each. And I had some left when I got back that I didn't need. And I went into Manhattan to sell them. And I was offered, I think it was 97 cents a piece. And so, the spread for that was over 30 cents. So I wasn't happy, but it was a small amount. And I just said, you know what? Okay, I'll go for it, because it's either that or keep all those euros in my pocket, which I can't spend in the United States. But here, no matter what transaction you're taking, there's always a bid-ask price associated with this, not just with currencies, but also with stocks, by the way. There's also a bid-ask price for stocks, and that's because it's a dealer market. Now, with the large transactions, though, if General Motors needs to buy £1 million, they're going to have a much tighter bid-ask spread, okay, because it's so much money. The dealer can afford to give them a better price. So for them, you might see something more like this, where the spread is less than a penny on each pound. But that's because it's a huge transaction. When you and I buy currencies, we're not buying that much. And so that's why the spread is so wide. So yeah, it's like 0.002 cents, dollars per pound. Although when you multiply that by $1 million, that's still a $2,000 difference. Okay, now forward contracts are traded directly between counterparties in the over-the-counter market. And the nice thing about that is that they can be customized to the needs of the two counterparties. So if I need to buy a foreign currency, not the British pound, for example, but a currency that doesn't trade as often, like the Icelandic krona, for example, I would have no trouble whatsoever negotiating a contract in which I can lock in the price at which I can buy my Icelandic kroner. Okay, so, and one more thing here. If you're the buyer of a currency through one of these contracts, you're said to have a long forward position. And if you're the seller, you're said to have a short forward position. All right. Now, futures contracts are very similar to forward contracts. One of the main differences is that futures contracts are traded on exchanges, like the Chicago Mercantile Exchange. So a forward contract, remember, is simply an agreement between two counterparties, like General Motors and Citibank, let's say. General Motors, they know that Citibank is a foreign exchange dealer. So they approach Citibank and say, Citibank, we need £1 million in 3 months. How much will you charge us? And they negotiate a deal. A futures contract trades on an exchange, a specialized derivatives exchange, like the Chicago Mercantile Exchange. In fact, I might be able to find, let's see what I can do here. Well, these are the contract specifications. This is a futures contract on the British pound. And the key details here are that the size of one contract is for 62,500 pounds, which is a lot of money. This is one of the drawbacks of futures contracts. The unit size can be very large, whereas with a forward contract, I can negotiate anything I want. Here, the amount is always 62,500 pounds. And in addition to that, these contracts only are available 4 times a year. There's a contract that expires in March, June, September, and December, and that's it. That's all we have. Whereas again, with a forward contract, you can actually negotiate any time limit that you want. So you might say to yourself, well, it seems like the forward contracts have a lot more flexibility. Why do I even want to think about a futures contract? And the answer to that question is credit risk. Any negotiation, like anytime you enter into a contract with a counterparty, there's always a chance that the counterparty could go bankrupt. So imagine yourself agreeing to buy currencies from a bank that goes out of business. Well, that's going to leave you holding the bag. Here, you don't have to worry about that because these futures contracts trade through organized exchanges like the CME, which guarantee the performance of the contract. Hold on 1 second. Okay. So yes, and so there's several differences between the two, but the one of the most important ones is this lack of credit risk when you deal with a futures contract because it's traded on an exchange like the CME. All right, now anything else? Yes. Well, we've already discussed this. A forward contract is negotiated with the counterparty, which means there's always a risk that the counterparty may default. Okay. Now, here's an interesting one. If you enter into a forward contract, that is a legally binding obligation. Realistically, you can't change your mind. Okay. A futures contract, it's easy to get out of your position by taking the opposite futures position. In other words, a long position in, let's say, a British pound futures contract can be offset by taking a short position in the same contract. So it's easy to get into and out of these contracts. And so that gives the futures contracts a lot of flexibility that you just do not get with a forward contract. And then finally, like for example, what if you enter into a December gold futures contract on the CME that enables you to buy 100 ounces of gold? That's a long position. If I decide at some point I don't need the gold after all, in order to get out of this position, I can enter into a short December gold futures contract on the CME, which is a contract to sell 100 ounces of gold. So I've actually got two contracts now, but their cash flows exactly offset each other. So in effect, I've completely unwound my position. Okay, that's easy to do with futures contracts, not so easy with forward contracts. And then finally, and by the way, because of that, in most cases with futures contracts, the underlying asset is never actually delivered because the other side typically unwinds the position before that happens. Whereas with a forward contract, if you enter into a contract to buy British pounds, chances are pretty good you're actually going to go ahead and buy the pounds. All right. So if you really don't want the underlying asset, you might be better off with a futures contract. Like here, whoever entered into this contract to buy the gold was only hedging their risk. They didn't really want to buy the gold. So that's why they used a futures contract. All right. And then there's this other bizarre feature called marking to market, where unlike a forward contract, you simply have an agreement. When the future arrives, let's say you pay X dollars for your British pounds. A futures contract is different. You have to put up collateral into what's called a margin account. And that account can go up and down in value every day. And you may actually be asked to put more money into this account multiple times during the lifetime of the contract. Now, the swap is an interesting one. What does the word swap actually mean? If I'm entering into a swap, or if I go to a swap meet, what is actually happening? The word swap is really just another name for trade. So the swap, what I'm actually doing is I'm entering into a contract in which I agree to exchange cash flows based on differences in economic variables or financial variables, like the ones you see here: interest rates, currencies, commodity prices, stock prices, you name it. You can arrange a swap on that particular variable. Now, by far, though, the most popular ones are the interest rate swaps and the currency swaps. So I have a simple example here so you can see what exactly is going on with these swaps and why one would actually want to enter into one of them. Okay, so for example, with an interest rate swap, cash flows are based on the differences between what we will call a fixed rate of interest and a floating rate of interest. Now, what in the world do we mean by a floating rate of interest? Well, you may have encountered this yourself. For example, if you have an adjustable rate mortgage, what does that mean? That means that the mortgage rate is reset every year. and we say that that is a floating rate of interest. It is changed every so often, whereas the fixed rate never changes. That's the whole point. Now, you may find yourself in a position where you are exposed to a certain type of interest rate risk and you would like to get out of that position. And one way to do that is to enter into one of these swaps. So let's see how that might work. And and by the way, of course, this is based on some amount of money, which is called a notional principal or notional amount. Now, I just want to mention here too, the floating rate of interest in these swaps is often something called LIBOR. And LIBOR stands for the London Interbank Offer Rate. Now, what it refers to is the rate that the major London banks charge each other for short-term loans. Now, for example, if Barclays and Royal Bank of Scotland decide to exchange funds or something, or Royal Bank of Scotland is borrowing from Barclays just for one night, the rate of interest they would be charged is the LIBOR rate. And LIBOR applies to all the major currencies. There's a dollar LIBOR rate, there's a pound LIBOR rate, there's a yen LIBOR rate. All the major currencies have a LIBOR rate. And so LIBOR changes every day. And so any derivative that's based on a floating rate of interest is likely to be tied to LIBOR. Now, interestingly enough, and this just goes to show you, LIBOR has been around since about the 1950s. And it works, and it seemed to work so well. But guess what happened? I forgot what year it was. It was pretty recently. A group of banks were caught in a scandal in which they were manipulating the LIBOR rate to make money at the expense of their customers. So now the LIBOR rate is being slowly removed as the interest rate that will be used for all these different types of derivatives and other contracts to be replaced by a rate which is unique to each country. So in other words, we're going to lose LIBOR because of these crooks, but that's the way it goes sometimes. The problem with finance, as great a field as it has a tendency to attract a lot of crooks. All right. And so these bankers who thought they could get away with it, well, they did not get away with it. And so, but because of it, the problem with LIBOR is that it's too easy to manipulate it. These other rates that are coming along will not be so easy to manipulate because they'll be set by that country's central bank instead of by market transactions. And so that will happen pretty soon. In fact, I think LIBOR is scheduled to disappear within the next year or so. But for all these decades, LIBOR was always the interest rate that was underlying these securities. But no, we can't have nice things because of crooks. So I don't remember what happened to the crooks. I'm sure they were all fired and they were all, I don't think any of them went to jail, but they got, let's just say that they won't be working in finance again. And so anyway, so here's an example. A corporation issues $100 million worth of debt with the following terms and conditions. 5 years, these are 5-year bonds. The coupon is LIBOR plus 2%. So in other words, every year, whatever LIBOR is on that date, that plus 2% determines the coupon for the coming year. It can go up, it can go down. Now, people who buy these things, of course, are hoping that the rate will go up. The issuer of the bond is hoping that it will go down. So it's a bit of a gamble. You don't see these very often, but you see them. They're often called floating rate notes because the interest rate is not fixed. Now, suppose this company issues the bonds, and then they suddenly say, maybe we made a mistake. We're starting to think that maybe rates will head up in the next 5 years. What can we do? We can't just take the bonds back. We have to pay this interest to the bondholders. Oh, here's a possibility. Why don't we enter into a swap? We find a swap dealer and say to the dealer, we want to pay you a fixed rate of interest, and we want you to pay us a floating rate. based on the $100 million. So the dealer says, sure, that's what we do. Okay. And so let's just say this is what they agreed to. The corporation will pay 6% to the dealer in exchange for LIBOR every year for the next 5 years based on this notional of $100 million. Okay, so let me show you a picture of this. So the corporation owes LIBOR plus 2% to the bondholders no matter what, based on $100 million. So if LIBOR is 5%, we have to pay $7 million. But the corporation now has entered into the swap. They're trading 6% to the dealer in exchange for LIBOR based on $100 million. Now, this is the cleverness of the corporation. The corporation pays altogether LIBOR plus 2 plus 6 the corporation receives, though, from the dealer, the corporation receives LIBOR. So the net amount that the corporation pays a net amount of 8%. So in other words, they don't care any longer what happens to LIBOR. Whatever it is, they receive it from the dealer and they pay it to the bondholders. So they're going to just pay 8% regardless of LIBOR. So they've taken a floating rate obligation and turned it into a fixed rate obligation because they were worried that rates were heading up. Now, if rates go up, they'll be very happy with themselves. If rates go down, they'll be upset because they could have saved some money. But this is how a swap is set up to enable us to offset interest rate risk. Okay, so we've converted one type of risk to another type. So these things are very, very powerful and very flexible. All right, so anyway, so now let's take a quick peek at options. Now, options are by far the most complicated, but also the most powerful and the most interesting of all the derivative securities. The name tells you everything you need to know about it because you can see buried in that word option, the word optional, which means that you have the right to do something, but not the obligation. In other words, you can change your mind. It's a lot like a forward contract in the sense that it gives you the ability to buy or sell an asset in the future where the price is agreed on today. But unlike a forward contract, you can change your mind. So it sounds like a very powerful security, which it is. Now, the only negative thing here is that unlike a forward contract, which is an agreement, doesn't cost you anything to get into it, with an option, you have to buy it. And they can be very, very expensive. That's the only real problem with them. Now, we'll see later on in the course how to determine the appropriate price for an option. Okay, and we'll also see some hedging strategies. Here, we just want to introduce the basic features. So first things first, what is it that characterizes an option? The underlying asset. This is what we have the right to buy or sell. And the number of things you can buy or sell with an option is literally unlimited. Like interest rate options we have, and we have currency options, and we have equity options, and we have equity indexes options. We have precious metals like gold and silver and palladium and platinum, and we have futures contracts, believe it or not. You can buy an option where the underlying security is itself a futures contract. And those are known as futures options. You can also buy an option on a swap, which is called, get this, a swaption. Yes, it is. That's what it's called. So this is, anything can be arranged really in principle. If you want to buy an option on, like I said before, the weather or the snowfall or whatever, it can be done. Okay. So now, yes, all right. So futures options, actually, believe it or not, most options really are futures options because they're so popular. They're very powerful and they're very flexible. So it turns out the majority of options trading in the marketplace are actually futures options. And then we already know what a swaption is. Oh, and I forgot, you can buy an option on a forward contract, and that's known as a forward option. And although it doesn't say so, oh, here it is. You can buy an option on another option. You can buy an option that gives you the right to buy another. These are called compound options. Options on options. And then the underlying security here, you could actually buy an option on a futures option or a futures option on a regular option. You can buy a swaption on a futures. I mean, the possibilities are unlimited. But for the most part, most of the trading takes place with the simpler ones. A lot of equity options are traded, especially interest rate options are very, very popular. Currency options, but we also have a lot of index options. These are all very, very heavily traded. In fact, the notional principal of all the outstanding options in the markets is worth something like $100 trillion. That's a lot of money, considering that this market really only got started in the 1970s. So options have been trading realistically for about 50 years in the United States. And look how big this market got. That's a lot of growth for something that didn't exist 50 years ago. Man, that's a lot of growth, but it's because they're so useful. It's like any other product in the market. Why does Bounty sell so many paper towels? Because they're so useful and they're not that expensive. Okay, so it's kind of the same thing. Okay, so then there's the strike price, the price at which we're allowed to buy or sell the asset. Oh, you know what I almost forgot to do? I would like to show you where to find option prices. Finance.yahoo.com. Let's go look for Apple, just because it's such a cool company. And if you look under here, oh, look at this, options. Look what you see there. There is a list of all kinds of options that are available on Apple stock. Wow, there's a lot. Look at them all. That's just, well, all right, that's some of them. This is the rest. Man, that's a lot of options. And by the way, you and I as individuals can buy options. They're not that expensive, actually. But they are very risky. And so if you call up a broker and say, listen, please buy me a bunch of options, they're going to have a word with you and try to make sure you really understand what you're getting yourself involved with. But you can do this. Now, the maturity is the length of time until the option expires. It only has a finite lifetime. So if you look at these options, these are about to expire on June the 4th. but they're available for all kinds of these different maturities. Like, for example, you see they go out as far as June 16th, 2013. Most of the trading, though, is in the short maturities, up to a year. Okay. And what happened? Oh, and by the way, the strikes are listed right here. So this one, for example, gives me the right to buy Apple for a price of $70. Considering that the stock is worth $124.28, do we all agree that that's a nice position to be in? I think we do. But then you have to be prepared to pay for it. The option costs $54.65. Ooh, that hurts. But if you bought this option 3 months ago, you'd be very, very pleased with yourself because you can sell it at a nice big profit. Now, if you do decision, now these options expire on, what is that, Friday? That can't be right. That might be Saturday. Friday, sorry. Oh, that is Friday. Okay, today's the 1st. I forgot. So on Friday, you have to make up your mind. Do you want to use this option to buy the stock or not? And if not, it just expires and you have no value. Now, there's two basic styles. The call option gives you the right to buy the asset. The put option gives you the right to sell it. They've organized it. The calls are here. The blue ones are called. These are all calls. And down here we have the puts. These are this one gives you the right to sell for $70, which is not very valuable. But the option to sell for $125 is worth about $1.42. Okay, and they can go, look how high they go. There's one down here that gives you the right to sell for $200, and that one's going to cost you $73.20. Okay, so you can see the number of choices is quite high, but that's, of course, because this is Apple. Everybody loves Apple. They want to buy or sell either Apple stock or Apple derivatives. Then there's one more classification here we should know. European options can only be exercised on the expiration date, like in the 4th. What happened? I lost it. Here it is. On June the 4th, you can decide exercise or not exercise. The American style options, you can exercise anytime you please up until that maturity date. So because of that, they're going to be very expensive. Okay. Now, most options fall into one of these categories, but there are other types that exist out there, and they're referred to as exotic options because they have very bizarre features. For example, let me just pick one at random. There's an option called a chooser option. And what happens is, let's say you buy it today. There'll be some date, let's just say that it's June 5th. On the date of June 5th, you get to decide if it should be a call or a put. Now that's very bizarre. You decide. Now, so they're called chooser options. I always wonder why they don't call them chameleon options, because you can change it at will. Ooh, that might be interesting. All right. And then the premium. How much do you pay? For example, does this option cost $54.65, whereas this one only costs $1.20? That's what you're paying to buy this thing. And this is the part that separates options from all the rest of the derivatives that do not have a price like this. That the pricing is a major challenge. Now, in fact, this is one of the reasons why options trading didn't really get started in the US until 1973, because nobody knew how to price them. So eventually, researchers came along and developed a model which we'll see later on in the course is called the Black-Scholes model. And that proved to be so important and such a breakthrough that the developers of that model were awarded the Nobel Prize in Economics. Ooh, now that's a biggie. It's not like the Grammy, where, you know, the Grammy. It's the real deal, the Nobel Prize. And so that shows you how important this turned out to be. So, and again, we'll discuss this later on in the course. Right now, we're just getting a taste of everything. It's kind of like you go into the store where they have ice cream and they offer to give you little tiny spoons and you can taste them until you decide which one you really want. So we've had all these little tiny spoons full of ice creams of different flavors. And so that's kind of the purpose of the first night of any class, to have little ice cream spoons. And then, so after this, we can get a little more deeply into these topics. What we're going to do next, not right this minute, is take a very deep look at interest rates and how they're determined in the marketplace, because all securities in the marketplace are influenced by interest rates. In other words, the value of any security you might choose to buy is going to depend on the level of interest rates in the economy. It's a very complex area of study. So we're going to start by looking at a model of interest rate determination, and then we'll start looking at the Federal Reserve System and see how they conduct monetary policy. But those are all very complex topics, not something that's appropriate for this hour of the night. So I think it's time to call it quits. And so everything we've done here is on Blackboard. Chapter 1, which we just finished, Chapter 2, which we haven't quite started yet, and the syllabus is there. Now, the syllabus itself showed that we were going to do 2 tonight, but I think we can save it for next week because it's not quite as long as what we just did here. And I think for the first night, we got a lot done. Don't you agree? Yes. Now, don't forget, tomorrow you're going to wow your friends at work by telling them how the name coupon came along for bonds. All right? Don't forget. All right. So I guess if nobody has any questions, I will see you all next week. All right.
Thank you.
All right. Good night, everyone.
Oh, Professor, I do have
Oh,
a
Good
question.
night.
Do you know
Right.
that you plan on doing the midterm? Just because I will be out of town and
Oh,
flying.
you know what? It almost doesn't matter because you'll be doing it at home anyway. And
Okay.
you'll be downloading it and doing it at home. And then I'll probably give you a couple of weeks to do it anyway. So I don't know
Okay.
yet, but it almost doesn't matter because, and plus if you're going away, I can give you even more time anyway.
Thank you. Yeah, it's
So
just the 4th of July. It's a couple of.
yes. Oh, everyone will have an issue on the 4th of July. So I'll keep it away from the 4th of July. Don't worry.
Thank you so much. I appreciate
Okay.
it. All right.
All right.
All right.
Okay. Good night.
Bye, everyone.
Bye.
Good night. Thank you.
Night.